The next learning objective is to adjust and close the accounts of a merchandising business. So even though we're working with the perpetual inventory system, which means we are perpetually or always updating inventory, we still need to count inventory at the end of the year, at least once a year. So why must we do this if we're already keeping track of inventory every time we purchase it and sell it? Well, there could be other reasons why our inventory amount could be wrong. We could have accounting errors. We could also have theft or damage, and this is called inventory shrinkage. So those are the main reasons why we still need to count inventory at the end of the period. And when we do, if inventory is not accurate, if anything, it's going to be smaller than we thought. So when we count the inventory, we're going to figure out how much has been lost or stolen, etc., or damaged. And we're going to lower the inventory count with a credit. Remember, the A means inventory is an asset and it's going down. And then we need to increase the expense account called COGS, cost of goods sold. So having theft, damage, and stuff like that is just a part of the cost of business. So we have to increase the cost of goods sold, and then we lower inventory to adjust for the shrinkage of the inventory account. So now let's figure out how we're going to close the entries or journalize the closing entries for a merchandiser. So if you remember, the 4 steps for closing at the end of the period are REID. R is revenue, so this is step 1. So in step 1 for a merchandiser, we have to close the revenue account, and that revenue account for a merchandiser is called sales revenue. Remember, revenue has normally a credit balance, so to close it so that it zeroes out the account, we have to debit it. And then we're going to be transferring that revenue temporarily to the income summary account, which will summarize our net income. The second step of the REID is expenses. So we have some new things for a merchandiser that we have to close. We also have to close the contra revenues. So that includes sales returns and allowance and sales discounts. So these are just temporary accounts. So revenues, contra revenues, and expenses are all temporary accounts. So we have to close sales returns and allowances and sales discounts. Remember, since they are contra revenue, they normally have a balance the opposite of the revenue. So their balance would be over here on the debit side. But to close it, we would have to put the amount on the opposite side to close them out. And then down here, we are just simply closing out all the expenses. The ones in blue are new. A delivery expense, I should say they're new for a merchandiser. A delivery expense for a merchandiser means if we sell some product to a customer and we have to pay for the shipping or the delivery, we just consider that a delivery expense. And then the one that sometimes students forget is an expense is COGS, cost of goods sold. So don't forget, cost of goods sold is an expense, which means it normally has a debit balance, but to close it, we would have to credit it. So once we close our contra revenues and all of our expenses, we input the other debit into income summary, which again is just a temporary account, which is going to summarize our net income. And then here's our bracket showing all the expenses. So we've done step 1, R, close the revenue. Step 2, E, we close the expenses and the contra revenues. And then 3 is I, which means income summary. So we're closing income summary to capital. So remember, net income is going to increase capital, and then net loss would decrease capital. So let's look to see in this closing entry what is happening to capital. So capital is being credited. And when we credit capital, that means capital is going up. So what must this income summary amount be? Is it a net income or a net loss? Well, if capital is increasing, then this must have been a net income. So step 3, we close income summary to capital. And then step 4, we close draw to capital. And withdrawals, always decrease capital. So that's why notice capital is being lowered. And we're closing out or lowering our withdrawals account. Remember, withdrawals normally have a normal balance on the debit side. So those are the 4 steps for closing a merchandiser. REID, revenues get closed. Expenses and contra revenues get closed. Income summary, step 3 gets closed to capital, and draws get closed to capital.